So today, it's actually a very interesting day for me to be up here because the Climate Change Authority review of the renewable energy target had its government response come back today, and most of the recommendations by the Climate Change Authority, which largely leave the 20% renewable energy target untouched, have been adopted by government. A bit of a global perspective, one of the things which informs how we think about longer-term issues, particularly around risk management, what is actually happening around the rest of the world, and there's some important trends there I'd like to talk about. Technology costs, obviously that is a huge issue for an investor in large-scale renewable or thermal electricity systems. And then the importance of policy certainty. It's one of the things which we rabbit on about at AGL quite a lot, that if you set the rules of the game for a long enough period of time, businesses can get on with the job of directing capital to affect the change that's required. So firstly, a global perspective. Things are slowing down in the developed world around electricity demand. This slide, which I'll gradually build up, and for those that can't see it, don't get too worried about the individual lines, but it goes from 1990 out to 2010, and you can see that electricity demand across the developed world has largely stagnated over the past few years. Now, you've probably seen a lot of media discussion around what's going on in the electricity sector domestically and falling or stagnant electricity demand. The purpose for showing this chart is to actually say, well, that's not a unique feature of Australian electricity markets. It's actually been happening around the world. And really the only part of the world where we're not seeing this trend play out are places like China and other parts of the world where you're seeing electricity systems being developed throughout areas which may not have had them in the past, and that's where all of that growth is really occurring. But the type of growth that's occurring is very different from what it was 10 years ago. So this slide shows global investment in all types of electricity generation capacity. The bars representing renewable in dollar terms. So you can see between 2004 and 2011, you have had almost a six-fold increase in the dollar investment in renewables globally. Now the red line, which I think completes this picture, shows the ratio of thermal investment to renewable investment in dollar terms, not capacity and not output, but you can see that you're almost down to 1 for 1. So for every dollar that's going into thermal capacity around the world, a dollar is going into renewables. And that is a fundamentally different picture from what it was a little bit less than a decade ago. And if you extrapolate out where a lot of countries are seeing their transformation of energy systems occur, you're likely to see renewables being the primary driver of new electricity generation investment globally over the next few years. The reason that's so important is that any individual nation in setting its public policy has to be guided by what's going on around the rest of the world. And what's been associated with this significant increase in investment is a significant decline in the unit costs of installing renewable energy. The latest turbine prices which we see in AGL would be, and this is wind, would be half what they were 10 years ago almost. And there's a bit of an Australian dollar impact there because our dollar is quite high, but certainly the unit costs have come down significantly. If you look at solar PV, some people are estimating that this year installing a solar PV system, an embedded small-scale system, would be 75% lower in cost than what it was in 2007. So with that type of driving force, this is no longer just a public policy issue, this is an economic issue. Where are those costs going to go into the future, and what might we see as a result of that? Electricity prices in 2020, one of the other reasons that I think this debate needs to be a little bit circumspect around renewable energy is that the biggest driving force of electricity prices domestically over the past 5 years, and they have increased by around 100% across the nation, has been network spending. Now, network spending is largely to keep the lights on due to peak demand, and there are a whole range of public policy issues that we can talk about. But if you look forward to 2020, our best guess is that electricity prices would be around 10% lower in real terms, even with the large-scale substitution of renewable energy that's required under the renewable energy target. So the concept that prices are going up because of renewables, if you do the numbers, it just doesn't say that. So technology change and costs. This goes, I think, to strategically how we're thinking through as an industry where costs might go. If you look at the red dots, they represent the installed capital cost of wind in the various years where we were able to make an observation since the year 2000. And you can see it's a little bit scattergun. There's probably some currency effects there. There's probably some turbine discounting depending upon what stage of the cycle you're at. What the lines show are three things that all relate to installing thermal plants. So combined cycle gas turbines, open cycle gas turbines, and then the gas price. And the gas price is probably the most fundamental part of that story, which I'll come to in a second. So you can see turbine prices for those thermal plant went up and then they came back down in real terms. But if you look at the one that shoots up into the sky, that's the gas price. That's the regional gas price. Why is that so important for policymakers to think about within Australia? Well, for the first time, there is increased pressure on domestic gas prices to reflect regional gas prices because of the development of export capability in Queensland. So most people in the room would have heard about these large coal seam gas fields that have been developed in Queensland and the construction of LNG terminals at Gladstone. That's all around supplying those regional markets. And if you assume that you have some degree of price linkage, gas prices start to become a major driver of thinking through where you might put your capital over the next few years. So the importance of policy certainty. This is one of the things which we talk about quite a lot at AGL, and I think it's fair to say that the Climate Change Authority, in thinking about renewable energy policy in Australia, and certainly the government's response to that review, has been to recognise that policy certainty. To show you how it's been a bit of a dog's breakfast, though, over the past 12 years, this gives you the 6 or so points in time where there has been significant uncertainty around the longevity and the form and the nature of renewable energy policy in Australia. From the creation of the mandatory renewable energy target, which placed an obligation on retailers like AGL to buy more renewable energy from the wholesale market, all the way through to the current Climate Change Authority review. But the most critical thing which I think needs to be remembered is that for the first time in 2007, there was bipartisan support not only for emissions trading, but also for a significantly expanded renewable energy ambition. And that's something which has guided a lot of the capital investment that businesses have made, and certainly preparing for this change that we're seeing with less investment in thermal capacity and more investment in renewable capacity. But the unintended consequences of getting public policy wrong are very significant. Now, for those that aren't in the electricity industry, this probably looks like a bit of a bizarre diagram, but let me just give you a quick feel for it. What it shows are the number of certificates for renewable energy that have been created since 2005, all the way through to 2010. You can see the very significant increase in 2010. That all came about because of the very poorly coordinated system of public policy for renewable energy incentives related to solar hot water and solar PV. So you had a situation where the market became so heavily oversupplied that no large-scale investment was forthcoming, and that was a very different outcome from what businesses were expecting based upon the rules of the game only a year earlier. So the unintended consequences of not getting these things right can actually leave businesses facing even more uncertainty because they're not sure what's going to happen next year or the year after. This slide shows the pricing impacts in those markets when you have these big public policy changes. So you can see that in the 2007 election, the price of a renewable energy certificate, which is what a renewable energy generator earns its money from, jumped from $30 to nearly $50 in the space of a week or two, simply because of the 2007 election public policy announcements. But likewise, when the schemes were tweaked as they were being introduced and you saw that significant oversupply coming down the pipeline, prices fell down again. So for businesses that are putting capital on the ground that are going to be expecting that that capital will earn a rate of return over 15 or 20 years, these types of policies work when they're set and then left to run. Where they tend to fail is where they're constantly amended, which is why we always go back to the first principle of, if the scheme is delivering what its public policy intent was to do, and there are no material reasons why you would change it, let it run its course. So, halfway through last year, we set about doing some quantitative work around why we thought there might be some inefficiency in the market for LGCs. Now, LGCs are just large-scale generation certificates. Again, don't get too worried about the graph, but what it's showing is that by 2015, under current market conditions, new supply would be required under the 20% renewable energy target. So someone would need to go into the market and build a new wind turbine or a solar thermal plant or something along those lines. Now, we did a market survey of what people thought the price should be to facilitate that investment, and then we looked at what the price was. The price was $36. Our optimal capital model said that the price should be $42, and most market participants said it should be between $45 and $50. There was this clear arbitrage opportunity. Why was nobody taking this money that was on the table? And the answer was pretty clear. There was a review of this renewable energy policy going on. You had significant players in the market calling for it to be repealed or for it to be amended, and that scares investors from putting their money on the ground. So the most important takeaway from this slide is that even where there have been significant economic opportunities for people trading in these markets, they haven't necessarily been taken because that history of stop-start nature of public policy has scared people away. But I want to turn to, I guess, a bit of a global issue now around where Australia's role in global capital markets, and certainly the perceptions of Australia in terms of our public policy certainty, are very important. Around half of the installed capacity in the national electricity market on the east coast of Australia is very heavily debt financed. So you're reliant upon constant renegotiation with financiers around what the terms of your finance should be. So we thought, well, let's look at what the spreads, and that's just the cost of money over and above what the banks pay, back in 2006, and let's compare that with 2011. We've put 2008 in there just to show that the GFC did cause a whole bunch of crazy things. But what you can see is that relative to 2006, today, spreads in our market are significantly elevated relative to where they once were. And we've put down the spread on BBB bonds as a bit of a comparator. Now, I wouldn't look at the absolute level there, but I'd look at the relative change. And the only thing that we can put this down to is the significant uncertainty in our market because of should we have a carbon price, should we not have a carbon price, should the renewable energy target be left in place or should it not? There are real economic consequences for these debates not being finalised. And frankly, the most bizarre aspect of this whole public policy debate, certainly I find personally, is that both major parties agree on a 5% reduction by 2020 and disagree on the mechanism, which is just extraordinary when it comes to public policy. Normally it's the outcome, not the output, which is where the argument is. So we set about trying to work out what the costs of uncertainty might be. We did a survey of all of the providers of large project financing in Australia, so around 14 of some of the biggest banks in the world, including our big four. And what we said is, if the renewable energy target was significantly amended, would you effectively prescribe an additional risk premium to refinancing and new financing of assets? And they came back and universally said across all technology types it would be 75 basis points. Now, what 75 basis points does to the costs of these technologies is slightly elevates them. And people might say, does it really matter that a combined cycle gas turbine goes from being $64.32 a megawatt hour to run to $65.05? It doesn't look that much. But when you've got effectively 200,000 gigawatt hours or 200 million megawatt hours being produced every year, you can see that a dollar starts to actually have a pretty material impact. And so I'll skip over that because that's open cycle. So what it leads you to conclude is that, and this is a very counterintuitive conclusion, the cost of amending this target is actually more material than any benefits you get from it from a reduced cost of deploying more expensive renewable energy. And the reason for that is that those middle baby poo colour bars, they effectively are the aggregated costs of higher wholesale energy costs across the entire market because of the fact that the whole market is seen to be more risky. What the red shows is the benefit you see from less expensive renewable energy flowing through the system. But a very counterintuitive conclusion is that you'd be better off repealing it than amending it. And that's something which some of the other players in our industry I don't think have thought through very, very effectively. The reason we put this out into the public domain is to say, before you start changing public policy, think about where the long-term trends are headed. We've seen what the costs of renewable energy are relative to thermal plant. We've seen the directions and the trends that's going. We've seen where all of this global investment is going in terms of dollars. If you've got a public policy in place which allows you to achieve early abatement at a relatively affordable cost, and at the same time you're actually developing the capability to deploy more in the future, maybe that's a public policy that's worth continuing. So, just two very simple conclusions, I guess, which kind of sum up the way we're thinking about renewable energy and carbon policy. Investors in power generation require stable policy frameworks, and if you amend policy on a whim, which affects investment which is designed to operate for 20 years, it's just not going to be welcomed by most investors. It's not right to say that investors in capital markets don't want to see any action taken to reduce greenhouse gas emissions. If they know the rules of the game, they're happy to play in the game as long as they know what the rules are. And the very counterintuitive policy outcome, which I think is very important in the current debate, because there is this media outrage around electricity prices. If you amend some of these policies with the public policy objective of reducing electricity prices, you might actually get it wrong and you'll be left in a situation where you're in a worse situation than you were to begin with. And that's the end of mine, so I will leave it there and happy to answer any questions during the panel. Thanks. So today, it's actually a very interesting day for me to be up here because the Climate Change Authority review of the renewable energy target had its government response come back today, and most of the recommendations by the Climate Change Authority, which largely leave the 20% electricity systems, and then the importance of policy certainty. It's one of the things which we rabbit on about at AGL quite a lot, that if you set the rules of the game for a long enough period of time, businesses can get on with the job of directing capital to affect the change that's required. So firstly, a global perspective. Things are slowing down in the developed world around electricity demand. This slide, which I'll gradually build up, and for those that can't see it, don't get too worried about the individual lines, but it goes from 1990 out to 2010, and you can see that electricity demand across the developed world has largely stagnated over the past few years. Now, you've probably seen a lot of media discussion around what's going on in the electricity sector domestically and falling or stagnant electricity demand. The purpose for showing this chart is to actually say, well, that's not a unique feature of Australian electricity markets. It's actually been happening around the world. And really the only part of the world where we're not seeing this trend play out are places like China and other parts of the world where you're seeing electricity systems being developed throughout areas which make renewable energy target untouched, have been adopted by government. A bit of a global perspective. One of the things which informs how we think about longer term issues, particularly around risk management, what is actually happening around the rest of the world, and there's some important trends there I'd like to talk about. Technology costs, obviously that is a huge issue for an investor in large-scale renewable or thermal electricity.